We're going to break down what the most important considerations are, what we typically approach with fundamentals, but more importantly, it's easy to understand what is important. And I can tell you a million things to watch, but it's more important to actually combine it into something, to actually make it worth your while and actually trade with it. So the whole genesis of this actual presentation is I wanted to combine, because this is something very personal to me, I started actually as a technical trader. And for a number of years, 3 or 4, it was just purely about technical trading. I was just purely into technical trading. And I didn't even know non-farm payrolls back then. I didn't have any concept of interest rate expectations. I didn't really think about risk-reward beyond placing my stop versus placing my target. I didn't think that far ahead. All right? I didn't think they were important. I thought that I could just get around it, did not have to necessarily pay attention to those type of things because everything was put into to the price action. But then I went to college. In college, you tell a college professor that who's actually worked at a big bank before that, are we going to talk about technical analysis? Are we going to learn anything about historical price action, carving that data up, seeing how it works, looking at the correlations in there? And I actually did that to one of my professors, and he was just horrified. He was offended I had said anything. That is mojo, and that stuff has no bearing on price action. This guy also, he washed out of that bank, by the way. I mean, there are two sides to this market, fundamentals and technicals. And I know that fundamentals are typically harder to grasp. Not many people are able to understand them, but there are very simple underlying fundamental themes that you can be watching. Generally, they switch between these particular themes, and that's where you need to go back and forth with. All right, but you should definitely incorporate fundamentals. Fundamentals are very important to trading. So let's begin. You already know me. I'm John Kicklighter, as that says. So we'll go right into the risk disclaimer, the most interesting part of this presentation. Obviously, these are the same risk disclaimers that you're going to get on all of them. It actually just says that there are certain risks to trading currencies. Leverage works against you as much as it works for you. You need to make sure that take your time. Understand what you're doing before you just jump in. I mean, that's actually not in the disclaimer, but I'm adding that in there. Be very careful with trading, all right? Leverage is a very disastrous thing sometimes. Sometimes it's a great thing, but you have to be able to use it properly. If you're unsure, you can always consult an independent financial advisor. So we'll start with my story, all right? I won't regale you with too much because I did go pretty in-depth with this last time. But I originally started out, as I said earlier, purely technical, all right? Purely technical. I had no concept of any fundamentals outside of the option. If you listen to, or if you know anything about options, I knew the Greeks, all right? Not necessarily fundamental, but as far as fundamentals as I got. Now, technicals worked for me pretty well. And I can't blame a couple of account blowups on technicals alone, but they certainly contribute to it. But technicals can include a lot of things. I mean, I started out with moving averages because the person that taught me, she's an excellent trader, she uses mostly moving averages. She uses trend-based systems. I also liked oscillators, Bollinger Bands, candlesticks. Candlesticks I use. I mean, once you learn candlesticks, you never go back. It's all about candlesticks. And I also like the ATR if you like individual indicators. I eased into fundamentals. Slowly, very slowly. And it was only after I had blown up a really big options trade because of the non-farm payrolls. It was really an ease out of necessity. I was dealt a pretty large blow, and I was a little upset. And obviously, when I get upset, I start to really run through everything I did wrong. So what I did was I tried to find out what happened on a Friday. What was this? It was an options trade. It's not supposed to move that fast. It was a spread. But it moved because of non-farm payrolls. So I started to get into some of the bigger indicators. But it was a slow transition, that's for certain. And it was really the college that got me into purely fundamentals. And I swear, if I ever brought up anything technical to this one professor, he would harp on me in the entire class. But fundamentals is what college was all about for me. I was lucky enough that there was actually a technical analysis course in there, but the guy that taught it, he knew absolutely nothing about technical analysis. I had been trading technical analysis for trading charts for 4 years before that, and I was incredulous. I could not believe that this man was teaching technical analysis. He was essentially had a technical analysis how-to book, and that's all he did. But fundamentals I have a very heavy backdrop in fundamentals now, specifically because of the finance and investment degree that I have and the fact that they focus on this so heavily. And a lot of that finance and investment was actually a backdrop of economics and global macroeconomics, which I was fortunate enough to be trading currencies at the time, so I knew that I should definitely be taking some economics courses because they're extremely important to this concept. So economics are actually where I learned a lot of the fundamentals, and if I were to say that if you were to get a finance degree versus an economics degree, I'd definitely say economics degree if you're talking about trading. All right? I actually get this question quite often. But from there, I started to combine the trading that I had been used to. Purely technical. I had a decent strategy in place, and it did all right, but it was the technicals that were really holding me back, and I was just going on them alone. And I started to combine what I was learning in college, which is not necessarily very easy when you have no real guidance on how that's done, because I did not. It's kind of difficult, and it's a lot of trial and error. All right, a lot of error, a lot of trial too, but and obviously from where I'm at now, and it's still a constant learning game. I still don't know fundamentals as well as I'd like to know them. I still don't know technicals as well as I'd like to know them. But from Daily FX, I have colleagues that work very well, and actually have a lot of people, a lot of you guys actually email me and tweet me, and you point out things that I didn't even see, which I like. And I think that combining all this, it's completely expanding my knowledge base. And certainly the years that I've been in Daily FX, I've learned a lot from all the people I've worked with. And we keep learning everything new every day, especially the new things we come across, and we share with each other. It certainly helps a lot. All right. So what is the value of both fundamentals and technicals? All right. I give you these 5 things. And these 5 things actually, they can be given to us by fundamentals and technicals. All right. Objectively identify the larger trend. Know what catalysts start and end trends. Preemptively avoid periods of extreme volatility, establish clear levels for entry and exit, and know when a trade isn't working out. All right, they don't do it perfectly. Nothing does work perfectly, but it does certainly help you. And these are not just one technical. These are not just one fundamental. In fact, the first one is technical. The 2 following are fundamental. Then the established entries and exit, which I use almost purely technicals, and then knowing when it's not working. That's a combination of the 2. Okay, so all these things can be done, but only really when you have a complete fundamental technical appreciation. We use them together, not independently. They don't work independently. I can tell you from experience. So we'll start with fundamental analysis. I'll give you the definition that it was given by Wikipedia. And I have to say this is a very lacking definition for our purposes. All right. Fundamental analysis focuses on the overall state of the economy, interest rate, production, earnings, and management. That sounds exactly like something a CFA would tell me. It is purely about the stocks. All right, there's just no doubt about that in my mind. So I kind of changed it around a little bit. I said fundamental analysis identifies those drivers that are broader markets used to guide capital flows. Capital flows, extremely important. Capital flows are where it's at. All right. That is, if there is one thing that you were to take away from fundamentals, always approach it from thinking about where the capital is flowing and why it is flowing there. Right. But goes on. This typically involves growth, interest rates, or themes for larger trends, and scheduled event risk for short-term volatility. So there's 2 considerations here. There is a medium to longer-term consideration. There's also a shorter-term consideration. That shorter-term consideration is the volatility impact. That's when you get the breakouts, the short-term breakouts. But if you want to see that follow-through, that consistency, that trend develop, that's more about those medium to long-term considerations through themes and some of the bigger issues like growth and interest rates and stuff like that. All right. So from a GDP perspective, growth. All right. You have to remember that everything is relative in this market. You're trading 2 currencies against each other. You're not trading one thing. All right. Too many people like to look at a euro dollar and they treat it like a stock. They treat it like it's Google. That's not how it works. You're seeing that one currency is appreciating against the other currency, regardless of what direction it's going. It's either the euro appreciating against the U.S. dollar or the U.S. dollar appreciating against the euro. All right. To get that appreciation, to get that up and down, you're going to have to see a relative performance. One of the things that relative performance really plays through and is very clear is GDP, relative growth. Right? How is the U.S. economy performing against the European economy? If you want to take an extreme example, how is let's say, Australian economy or the Canadian economy doing against the Greek economy? All right? I'm going to pick on Greece throughout this, so get used to it. But you can get these extremes, and you can really understand where they're diametrically different. And they're not necessarily the be-all, end-all in the fundamentals. Actually, this actually feeds into interest rates, which we're going to talk about next. But GDP is a very easy kind of measure, all right? Very easy indicator to see how it's working. But you have to be careful. This is not for short-term kind of trading. This only comes out on a quarterly basis, so you can tell just from that nature of when it's released on a quarterly basis that it's more of a slow over time, gradual impact on fundamentals. But for people that follow the performance of GDP, you're going to see that over time you will have those big sloping trends, and you'll see over time how they're performing. All right? Interest rates. Interest rates are very important. Very important. Ilya and I were having this conversation just the other day, and he and I get into a lot of economic debate. He actually convinced me of this. Saying to him that interest rates aren't necessarily that important. Well, they are very important, but they're not the be-all, end-all. All right? But he made a very convincing argument that why is growth important? Growth is important because growth leads to expansion in earnings, expansion in payments, and thereby the rise in those interest rates. Okay? Those interest rates are the end game for what's happening for the fundamentals to start. All right? So interest rates are actually, almost everything comes back to interest rates. Fundamental themes, risk appetite trends. Those actually settle back down to interest rates. Why, if I'm talking about risk appetite trends, maybe risk appetite is rising or falling, but I'm looking at the Aussie US dollar. Very wide yield differential, and it will respond to those changes in risk appetite trends because it necessarily has a tolerance or high yield differential. All right? So interest rates are actually one of the most critical components of fundamental analysis, in my opinion. I think that if you're really learning something beyond the capital flows, obviously capital flows are extremely important, but if you're looking for the outlook component is really going to be founded in how does this impact interest rates? How does this impact yield? All right? Benchmark interest rates aren't the only thing you look at, though. You also look at LIBOR rates. That's why we mentioned them in our analysis. You also look at overnight index swaps. These are all market-based rates. They are rates. All right? These yields are very important, regardless of what type they are. Benchmark interest rates are exactly what they're called, benchmarks. Interest rates like LIBOR are going to be much more about markets or rates that you can actually access. Guess what? If you try to go get a loan from the Fed at 0.1%, they're going to laugh you out of there. All right? It's not, the benchmark is just a benchmark. The actual rates you're going to be able to really apply for are going to be more along the line of a 30-year fixed rate loan. All right? That's credit risk above and beyond, but that's a market rate versus an underlying benchmark rate. Fundamental themes. Themes is the most difficult thing to grasp without doubt. There are many themes that could be playing out at any one time. It's really in identifying which theme that is most important. Bringing over the example we talked at the last presentation, euro dollar. What is the most important theme? Without doubt, it's the financial situation in the eurozone. It's going to be that at least for the next week. But after the next week, it's going to be shared with something else, the Fed's rate decision. All right? The Fed's rate decision brings with it the possibility of quantitative easing, further quantitative easing after already 2 rounds have failed. So that third round of quantitative easing actually could significantly depreciate the value of the US dollar. That's going to be something that fights against the European financial situation because the European financial situation is pushing the euro dollar down. But then again, if you want the US dollar to continue appreciating against the euro, it can't be faced with something as significant as potential further quantitative easing. So you have to understand what the themes are, and sometimes you know ahead of time when those themes shift. All right? And right now we have a unique situation where we're able to see that there is potential roadblocks and shifts for these fundamental themes, specifically for the euro dollar. But with this is just my basic example. The S&P 500 versus the Aussie dollar. All right? Risk appetite, quite clear actually. There's some instances of deviation, but over time that correlation has held up to be very, very stringent. And knowing that, I typically almost always approach the Australian dollar first with the thought of fundamentally, what is interest rate, or what are the interest rate expectations, what are risk appetite trends? All right, those are the two things that I really pay attention to. Interest rates, because that is what's actually tethering us to risk appetite trends, but risk appetite trends because that is what's actually moving the market up and down. All right, just the fact that it has high yield differential, the Aussie dollar, doesn't necessarily going to be very volatile unless you have people looking for higher yield or looking to get away from risky currencies. All right. End event risk. All right. Eurodollar, a chart before we had all the recent volatility, but you can tell that there's a lot of back and forth here. Actually, I wanted to identify some of the big swings that we had here, and they're actually driven by short-term event risk. Event risk that not necessarily isn't well known. You can't see it ahead of time, but there is plenty of that as well. You look at the economic calendar, you know what's coming up. But sometimes some things in terms of event risk are more financial headlines. So back there in April, we had the ECB official signal the further rate hikes. I don't know if you guys remember this, but back in April or until about the beginning of May, euro was just so strong because the ECB just kept talking about interest rates. All right, the market had thought at one point that they were going to hike interest rates by 150 basis points in the span of a year. All right, that's 6 hikes in a year. That's a hike every 2 months. That's really aggressive, especially where we know where we're at now. We're falling back into a global slowdown, not necessarily a recession yet, but we could get there. And a financial crisis seems to be spreading across the borders. But back in April, that wasn't on people's minds. People were really paying attention to the ECB, who, they got over Greece, they got over all the problems that they had in Portugal and Ireland, spreading over to Spain and Italy. Well, not necessarily yet then, but they were just paying attention to interest rate expectations. All right. So as he signaled with the rate decision there that they could potentially, or his ECB Trichet's commentary, that they could potentially further rate hike rates. Yeah, that big rally. All right, but then when the rate decision came along and he completely offset that speculation, boom, right back down. All right, this kind of event risk is not necessarily known. You can't necessarily see it on an economic docket all the time, although the ECB rate decision you could definitely see coming. But these things you have to look for. All right, event risk doesn't necessarily just have to be one of those. There's NFPs, or there is the Eurozone retail sales, or indicators like that. All right, not all indicators are created equally. There are some things that are much more important than others. All right? How can we get risk on, risk off switching so quickly? All right, it seems to move very quickly. He said, how can it switch within a week? I argue that it can actually be within minutes. But the Euro Swiss is actually a very good example of this. You had a situation where, out of the blue, somebody that was short Euro Swiss, and they were short Euro Swiss for a speculative position. All right, they might have been in at 116. All of a sudden, the Euro Swiss can no longer be below 120. The S&B just completely undid you. That's going to kill speculation in that pair. That completely negated all downside speculative interest on Euro Swiss, unless you want to take on the S&B, which I wouldn't recommend. That is manipulation. On the other hand, you have something like, we'll go back to 2008. Back in 2008, October, we had a situation where it really wasn't, this actually was brewing for a couple of weeks in the background, and the public wasn't privy to it, but all of a sudden, Lehman Brothers, Bear Stearns already had gone under, but Lehman Brothers, they could not find capital. All right, they withdrew all their capital lines, all their short-term loan lines, and they couldn't raise necessary capital to day-to-day operations and cover their exposure. That was a liquidity crisis, an immediate liquidity crisis. And when the market was privy to that, all of a sudden they think, oh no, here's a major bank that holds a large section of the United States real estate market, and they are done. They don't have the money necessary to continue. Guess what? Every bank is going to say, pull all our lines, pull all our lines. Doesn't matter what bank, pull our lines. We keep our credit at home. All right? All of a sudden, you can't find liquidity. And those traders that were previously doing well for a very steady, calm market, no longer. They can't participate in that market. They have to pull out. They have to sell at all cost, no questions asked, because their risk manager came to them, tapped them on the shoulder, and said, "You're out. No trades. All booked." So let's move into technical analysis. All right. This is, given our earlier poll, most of you are here. This is what your love is. And I have to say that I love technicals as well. That's why I haven't completely given up on them. But the general definition, and this is even worse than the fundamental definition, it's terrible. A discipline for forecasting for the future direction of prices through the study of past market data, primarily price and volume. Well, guess what? In FX, we don't have volume. FX is just it's a decentralized market. There aren't common exchanges where we can easily measure volume, so we don't have it. We don't have it available to us. There are alternatives to it, but not necessarily very useful. All right, my definition. Identifying and exploiting patterns in historical price action that will likely repeat themselves or follow an expected path. All right? Often considered an objective assessment of behavior through crowd mentality. I added that second line and I bolded that second line because crowd behavior is actually very important. This is an often overlooked aspect of analysis. If you have the chance to come across a very good book on trading behavior, depending on what your experience is, if you have experience with finance, you can look into game theory books, or if you just need a more intro-level book to behavioral analysis, look for it. I think even Jamie's was actually about behavioral analysis and combining with technical analysis as well. But very important concept and very important for including in the technical analysis section. All right? So we look at the technical analysis from an indicators and oscillators consideration. I like specific indicators. I don't like every indicator. I know a lot of people will go through and they'll test every indicator. Well, guess what? I already know from actually from doing it myself that many of these indicators are very, 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 very similar. All right, specifically because they are based upon the same data, and their calculations are very similar themselves. All right, they just add a little tweak here or there, and they will give you the same general readings. All right, too many people use one indicator to confirm another indicator, and if those two indicators are essentially the same thing, all you're doing is confirming an original bias. That is not good confirmation. All right? It's essentially like trading the Aussie dollar and the Kiwi dollar at the same time. It's the same trade. All right? They move on the same tack. You don't want to do that. You want to make sure that you have something that's independent that really verifies what you're looking at from your strategy perspective. All right? So I like Bollinger Bands because standard deviations are actually very interesting in terms of measuring volatility and measuring the activity itself of the market. All right, and it also incorporates a nice moving average, 20-day. You can always change the input so that it's wider. This is actually a 2 standard deviation Bollinger Band. And you can see that right now it's getting a little, and from this chart, obviously we know what happened recently, and if we were looking at it recently, you would see that these Bollinger Bands will be widening out very rapidly, and the price itself is actually below the lower Bollinger Band. But it gives you a good sense of the level of activity of this market, and sometimes direction, all right? It's volatility oftentimes that kind of precedes direction. So we look for these indicators, and I think this is one of the really useful ones. There's millions, but I chose just a couple of them. The average true range, another one that is good at measuring activity level. All right, average true range is just a measure of the past X number of days. Let's say the past 10 bars, and we'll see the high-low of those past 10 bars, and we'll divide them by 10. All right, add them all up, divide them by 10, that's the average true range. And what that tells us is if right now the average true range is maybe 1,000 pips on the euro dollar, the past 10 days have averaged 1,000 pips range. That is a very active market compared to maybe, let's say it was 10 days ago and it's going to only be 250 pips. That is a dramatic change in the activity level of this currency pair. Something has significantly changed. And obviously, if those changes are occurring, you want to change your strategy. You want to change your approach to the market because that kind of volatility you cannot just sit through. All right. So I like to use the Bollinger Band and ATR specifically. These are my go-to indicators and oscillators, but there's others. From price patterns, this is where most of my technical analysis is. I like to look for patterns. It can be congestion. It can be channels. It can be anything. All right, I've seen people that have cup and handles and head and shoulders and all that. Those are common patterns. Some people have come to me with patterns I have never heard of. I think they've actually made them up as they went along. But hey, if you can find patterns that you think consistently repeat themselves and you can actually break down why this is so, then that actually gives you something that can be incorporated in your technical analysis. We see here a rising trend channel. This is actually a weekly chart of the S&P 500, and this is the one that me and Ilya were watching on a daily basis, even though it was a weekly chart, because it was frustrating us so much. And you can see that that rising trend was here, and it looked like there's a good potential for a reversal. Why? Because you had the head and shoulders pattern there. In a head and shoulders pattern, you can have the technical indicator, but it's also important to, or the technical pattern, but it's important to understand why this pattern might turn into a reversal itself and why it is actually important. Why it's important? Because it has a consistent floor, all right, a steady floor. But then it has you have the left shoulder, the head, and the right shoulder. Now, the right shoulder more frequently should be lower than the left shoulder, but that's fine. It doesn't have to be. But the fact that it went higher high and then a lower high, it's a good predecessor to a potential reversal and trend. All right, especially on something on a weekly chart. That's a very good potential. All right, so price patterns, head and shoulders, are actually ones that I've been pointing at in the past couple weeks. I've pointed out a ton of them because I think that they're one of the better price patterns. But email me if you guys think that you know better ones and give me some examples. I do like to incorporate what you guys point out to me. And behavior. Behavior analysis is in a league of its own. It could be put into technical, it could be put into fundamental. It should really stand alone, but it does incorporate into both, and I'll put it into technicals. But behavioral analysis is essentially saying, what is the market doing as a whole? When you see the S&P 500 rally really aggressively, you have a behavior where people are looking for risk. They're looking to get into the market because they think that there's a good chance of high returns. And it will build up and build up and build up, and people will get in and get in and get in until the point where they think it's oversaturated and the possibility of further gains through capital gains are too low. Right? And then it'll peter itself out. But this behavioral analysis is also very prone to the same things that we try to learn away as we go. All right? We're trying to get away from fear. We're trying to get away from greed. All right? But greed and fear definitely comes into the group. All right? The group mentality. When the market is looking at a situation like we were talking about Lehman Brothers, that's pure panic, pure fear. All right? They don't care at what price they get out at that point. They need to get out. That is panic. All right? And you can see this back and forth, and it's very difficult to ascertain in most markets, especially if you're talking about the bank level or perhaps from the central bank level, although they try to telegraph when they're making big moves like that. But from a retail level, we actually have a pretty good gauge of this, and that we use the SSI. If you don't know what this is, you should definitely get familiar with DailyFX Plus. We have the SSI gives a good measure of the net positioning of FXCM clients, long and short. All right? So with this is the dollar Swiss. We actually saw that this is through about late August. And you saw with the reversal there that even though we had that reversal, everyone was still long dollar Swiss. We actually haven't seen a negative turn or more shorts than there were longs for dollar Swiss amongst the retail traders in a number of months. And if you look at the dollar yen, it was essentially years until we came up to that financial crisis back in March. But you can see here that one red bar, I don't know if you can see it really well, but that one red bar, oh, there we go. There's a one red bar right here. That's when it finally flipped. All right, we finally had more shorts than we had long on the dollar Swiss, which is a remarkable situation considering how they've been positioning for so long. Retail traders make a lot of mistakes. All right. Unfortunately, that's what you guys are here. We're all here to learn, but too many others, they will just get into this market and they will make every mistake in the book. All right, that's why SSI works relatively well, because they make those mistakes and they don't want to fix them. All right, new people will come in and they let their stops run. They take their targets too soon. They leverage up. They double down. Everything that you do here in Vegas, that's what they do on their trading. All right. This is not what you want to do in trading, but it's those inherent negative biases that they should not be doing, they should be avoiding. That's actually what gives us a very good setup for using the SSI as a contrarian indicator for those big changes in trend. Okay? There's a whole trading mentality when you're talking about contrarian trading and using the SSI, I'll defer that one to the actual presentation that's based on that specifically. But behavioral analysis is exceptionally important to incorporate, and I would definitely encourage everyone to at least read something on the topic. If you want any white papers, I actually know some white papers that you can read. A little technical, but if you can grasp them, they're actually pretty good reads. All right. Now, how do fundamentals fit in the picture? First, I want to talk about the arguments made against fundamentals. And I get these from Jamie on a daily basis, so I'm pretty familiar with them. Often seen as too long-term. He thinks most of the time that they just don't give us any information that's not already priced in the market, and it's too forward-looking, and it's not giving us any kind of actual trading at right now. I counter that with a reaction to non-farm payrolls. All right, non-farm payrolls. Huge reaction, knew that that indicator was coming out, and it had a good likelihood of driving volatility, so why not know that that fundamental was coming and prepare for it ahead of time? All right? Doesn't offer a clear signal for extremes. At the extremes of major trends, fundamentals will turn gradually. All right? Like when we had the S&P 500 as it just consistently charged higher, we were looking at it, and we certainly saw earnings were relatively strong, but the economic activity and the fact that those earnings were based more on cost cutting than they were from actually selling products, because countries around the world were seeing that their economies were really not doing very well in the consumer sector or actual business activity sector, but more from the investment perspective, which is not a lasting combination. All right? That means that it's going to be a slow turn. And slow turn was already taking place before you actually had the reversal from the S&P 500. That's fine. I'd rather know that that's going to happen ahead of time and be patient and see it take place, rather than not know it was happening altogether and just kind of be pleasantly surprised from a technical perspective. All right? I can live with that not being a clear signal from extremes. That's why I'll incorporate technicals. Too concerned with explaining rather than forecasting. This is Jamie's big problem. This is somewhat true, where fundamentals, many people just look at fundamentals because they want to explain what happened previously. Most of the things that you read on like these major financial institutions, if you watch CNBC, all they do is tell you what you already know. All right. What you really want to know fundamentals for is its ability to tell you what themes are important and what you want to take forward and what's going to drive price action. Knowing what the theme is a big leg up, so that you can see when that theme starts to pick up. Maybe I'm not looking at Aussie dollar itself. I'm looking at the risk appetite trends, and I can see that this particular thing is going to happen that will drive risk appetite trends. Then you know that there's a very good chance that's going to spill over to the Aussie dollar, because that's the major theme that people are concerned about. All right? So it does explain, but you have to use it right to do more of the forecasting. All right? This is a big argument. This is one that I have to say is valid. It can sometimes seem conflicting. Fundamentals can seem conflicting. There are a ton of things out there. Everything is happening. It seems people that have just paid attention to non-farm payrolls would say, oh, there's a non-farm payrolls here. It was 0, like the last one. Shouldn't we see like the U.S. dollar just drop off? First of all, that's a fallacy of just associating the non-farm payrolls, the event risk, with the U.S. dollar straight out. That's not how it works. It's more about risk appetite trends, because as you see that release, non-farm payrolls, that tells us that growth is probably going to slow. The probability of bigger problems coming later down the line is going to grow. So equities will drop off, all right? And sentiment will drop off. But global sentiment will also drop off. And as that global sentiment drops off, people are looking for a safe haven. And the safe haven are very few and far between now that SMB decided they want to drop out of the game. That means we drive us back to the U.S. dollar, all right? So all these fundamental drivers out there, and it can certainly have significant impact, but some don't. You have to look for the major theme. We look for that theme when we know which one is the dominant driver, and that's what we follow, okay? And unnecessarily complicated and overwhelming, that's just Jamie's, I don't want to learn it, so it's complicated kind of argument. But it is certainly complicated. Anything worth learning, it needs to be done over time, okay? You should take the time to do it if it's worth learning, because it itself is worth learning. And I think that fundamentals is definitely worth learning. So while it might seem complicated at first, and it might seem overwhelming, it's not overwhelming. You can do it. If I can do it, you guys can definitely do it, all right? But why are fundamentals important? It's much easier to identify the correlations that I what we talk about on daily effects all frequently, like we were talking about the S&P 500 and the Aussie dollar, the Kiwi dollar. Much easier to identify that through fundamentals, rather than having to go through and testing them all and putting them all in the same chart. If I told you that it was risk appetite was rising very aggressively, I would look at S&P 500, I look at Aussie dollar, I look at Kiwi dollar, I look at Aussie yen, I look at Kiwi yen. I could tell you all the pairs that I would be looking for. All right. Why do I know that? Because I know from a fundamental perspective that risk appetite trends is moving, and it has this connection to these pairs. All right. So rather than having to go test through each one of them, which would take me a very, very long time, I've done it, by the way, I can intuit from the fundamental side of things that this is what is happening. All right. Better prepare you for volatility and scheduled event risk. Obviously, if I know non-farm payrolls is coming up, I want to avoid it if I have a short-term trading system. Maybe I'm looking for a range-based system on a short-term chart. Maybe I'm doing something like Michael is doing. He likes to scalp. If he's scalping, he can't take a scalp right ahead of non-farm payrolls because he's looking for 20-point target, 20-point stop. A scalp on a non-farm payrolls day is going to be a disaster, all right? Utterly disastrous. But you look at fundamentals, you should know what the event risk is. Technicals sometimes fail when fundamentals are balanced. This is absolutely true. When we see that growth between two economies is balancing out, all right, technicals start to break down. They start to level off. Dollar yen, all right. Why is dollar yen just bouncing along? It seems to be doing nothing. It's because fundamentals are relatively balanced. The fact that the Japanese yen is a safe haven, more of a funding currency situation versus the US dollar is more as a liquidity situation, those two concerns are balancing themselves out. That's why that has kind of chopped along at the bottom. That will shift further toward going to where the US dollar is more attractive than the Japanese yen as we make a further shift. All right? But at that point, technicals seem to completely break down. Technical traders are no longer interested in dollar yen unless they're looking at something like a monthly chart or a weekly chart, but few people do that. I would say fundamentals would say stay interested, stay very interested, just wait until it happens. All right? And identify larger trends are growing exhausted. As I said, you'll see that the fundamentals will start to level off or turn around well in advance of something along the lines of technicals. All right, the technical trend continues to rise, like the euro dollar continued to rise to the interest rate expectations. All right, but interest rate expectations started to curve off a little bit beforehand. It just took technicals a little time to catch up. Same thing with S&P 500. It was leveling off a little bit. Fundamentals are already starting to turn negative. All right, people are realizing that expectations for growth was just growth in terms of capital gains and growth in terms of the economy were just overblown, especially because a lot of them was based on quantitative easing, and that had natural limitations. All right, so fundamentally, we knew that was going to come eventually. That's why Ilya and I were chomping at the bit at this every day, even though nothing happened. But eventually, it did happen, and technically, it broke. And that technical offered confirmation, but it didn't tell us that was coming ahead of time. All right. So let's look at a view that's restrained specifically to technicals, Aussie dollar and Kiwi dollar. I said that if you're trading those two, you're essentially trading the same pair. But there are times when it deviates. Okay. And what would that deviation? Where does that deviation come from? Well, you can see right there. That deviation actually comes from interest rate expectations. All right. Yield expectations. All right, you would not know that if you were just a purely technical trader. You would say, I expect the Aussie dollar and Kiwi dollar to trade at the same pace, and that's just what that is. All right, but from a fundamental perspective, I would say, well, when you see that yield spreads are going to widen or contract in favor of the Australian bank or the New Zealand bank, you're going to see that oscillate, and you'll see the Aussie Kiwi really take a different path. Okay, somebody that was purely technical would have no clue about this, no clue whatsoever. But you do have to avoid analysis overload. And from a fundamental perspective, there are many fundamental themes. You need to be able to touch upon and follow those that are most important. All right? Don't try to follow every fundamental theme. They'll often conflict, and if you give them all equal weighting, you will miss the bigger one. All right? Assuming every economic indicator is market moving, this is a big fallacy. Everyone assumes, and I think it's more of a media doing it to you, that non-farm payrolls is going to be huge. We're going to dedicate all our top headlines to this, and we'll send out all these stories about how non-farm payrolls is so important. It's not necessarily that important right now in terms of a market moving perspective, because people know what the economy is doing. People know what the general trend is in employment. All right, so you can't always assume that every indicator is going to be that market moving. It's just not going to be the case. You need to know when, sometimes when market event risk itself might not be important at all. All right? You have to be able to identify that. Assuming themes do not wax and wane as market interests change. Now, this is very important. Risk appetite trends, while it is almost always important, there are times when it does not drive the market. And we saw that with the euro-dollar example when it was really following interest rate expectations rather than the S&P 500. That's why the euro-dollar and the S&P 500 chart deviated so dramatically. All right? It's because those themes do wax and wane depending on what is important, what the market's really touching upon. Now, how do technicals fit? The argument's made against the technicals. Too easy to find patterns where none exist. It's like drawing. It's like seeing shapes in clouds. That's true to a major extent. People say that, oh, you're just finding patterns where none exist. Some do. Some do not. You have to look for the patterns that are most consistent. Anything in trading is probability. All right. What's the probability that this pattern is a very important pattern, a pattern that will lead to price action going forward? If you're telling me that a cup and handle on the pound dollar is an important pattern, I would argue with you because I've actually looked through a number of cup and handle patterns, this on the 4-hour chart or the 240-minute chart, and the pattern just does not have consistency and follow through. All right. It never plays out. All right. But a pattern like head and shoulders, which is why I keep touching upon this, works very often on many different pairs. So I watch that specific pattern. Efficient market hypothesis. This is more of my professor's kind of argument. Technicals don't matter because everything that's known to the market is incorporated immediately, and thereby it's not going to move on anything else. All right. It doesn't matter if it's an efficient market and it's not an efficient market because everyone trades with a bias. I am, let's say, very pessimistic about where we're going in terms of economic activity. The market as a whole has a bias itself. So these things will actually skew any kind of efficient market hypothesis because no one is going to be a common, reasonable mind. And also, it doesn't matter. Technicals will override that particular concern. Right? It doesn't matter whether you're plotting the sentiment or you're plotting just a pure market that incorporates all the fundamentals. You will see those technicals still play out as they shift. Okay? Past performance does not guarantee future results. This is the same as finding patterns that don't play out. That's certainly true. Patterns, but anything in trading is probability. All right? Anybody that tells you that they can make consistently 100% of the time profit is lying. All right? They probably only traded twice and got lucky twice. All right? Over time, you will see losses. All right? Any strategy will. All right? It's because the market just is not forecastable. No one can know what's going to happen in the future. Things shift and things change. But that is a probability itself. All right? You're taking a risk. So the probability is also implied upon the technicals. All right? There's a probability that this pattern plays out. There's a probability it does not. But you look for the patterns that have a higher probability of playing out. In my case, I like the head and shoulders as good examples of this. All right, and a lot of people say that just following technical analysis follows blindly into unforeseen volatility. So if I were just looking at technical analysis and I see that price action is pretty stable, we got some back and forth on euro dollar, but all of a sudden, boom, huge drop. Non-farm payrolls, didn't see it because I wasn't paying attention to the fundamentals. That's true. That's true. That does happen. But sometimes before non-farm payrolls, most of the time before non-farm payrolls, you see consolidation. Less price action, a little bit of a pullback, and people kind of wait quietly to see what's going to happen. All right? So you can see that a little bit to some extent, but it's a good argument for incorporating the fundamentals. Why are the technicals important? There's any number of reasons. I could get Jamie in here and he'd preach it all day long, but the catalyst for a speculative run. All right? When you see a breakout, that's when it's that initial technical breakout that usually instigates a significant trend. The trend may have been building up from a fundamental perspective for a while, but it's that breakout that really got it going. All right? And you wouldn't know that if you didn't look at technicals. Identifies sudden halts or cooling to an existing trend. As I said, those fundamentals change slowly over time, and they can let off a little bit off of a trend. And like the S&P 500, we really started to doubt the potential and growth in terms of quantitative easing going forward, but the markets continued to move. All right? When it suddenly halted or when it suddenly cooled, that's what we need to look at. All right? That price action is what we're trading, so we need to see that price action to see what it stops, and that's what we trade. Though we have our fundamental belief, we see when it actually stops, so when we actually stop trading it. quickly established a dominant trend, I can look at any chart that you give me and I can tell you the general trend, whether it be sideways, bullish or bearish, in less than a fraction of a second. It's very easy to do. Fundamentally, you'd have to do perhaps a lot of background checking. But from a technical perspective, I just look at it and you know generally where the trend is. Right. And offers reasonable levels for entries, targets, and stops. This is exactly why I think technicals has to be in your repertoire. You cannot just fall back on fundamentals because you need to know where's a good level to get in, where's a good level to get out. All right? And the best way of doing that is not from fundamentals because those are a little bit slower or they're extremely volatile, but there's a very little middle ground. You get that from technicals. All right? These technicals tell us these are good levels. All right? Not fundamentals. And they cut through conflicting and confusing fundamental noise. Sometimes when you have a hard time pulling apart the themes and you can't really tell which one's more important or what indicators are more important. If you look at technicals, it'll tell you which fundamental driver was more important because you'll see it impact the market. All right? And it's a very good equalizer in that aspect. All right? Let's look at a view restrained to fundamental analysis. If I were looking at the interest rate expectations and S&P 500, I can see that compared to the New Zealand dollar. All right? New Zealand dollar is on the right side. The red line is the S&P 500. The blue line is the yield expectations between the RBNZ and the Fed. All right? If you thought that it was just purely about risk appetite trends for the Aussie dollar, well, you would not be doing very well in the Kiwi dollar because as the S&P 500 was dropping back, the Kiwi dollar was actually still advancing. All right? And that would confuse a lot of people. But if you look at the proper theme, all right, if you look at the correlation that you had there, which is much easier to find through that correlation, you see that between those two, that interest rate expectation and the New Zealand dollar, much more consistent. All right? So that correlation, very easy to spot on that chart. All right? So if it was just kind of restrained to the fundamental side of things and we were expecting just risk appetite trends, we would kind of miss this. All right? We would be completely off kilter when we were trading the Kiwi dollar. All right? But avoid analysis overload. It's very easy to do as well in technicals. You expect every pattern to play out. I see a head and shoulder. I can spot a head and shoulders pattern on any currency pair right now. All I have to do is move through the time frames. But I can tell you with significant certainty that probably 90% of those are not going to play out well. And you start to get a feel for when they actually do set up very well. But every pattern, just because you can spot it, does not make it a good pattern. Looking for confirmation from indicators, this is what we were talking about earlier. You don't want to take two common indicators and use one to confirm the other. All right? You're confirming yourself. All right? It does not give you an independent, objective analysis of what you just looked at. It just is confirming you because you're looking for confirmation. Expecting exponentially more difficult technical analysis to show hidden factors. There are so many indicators out there, and they seem to be getting more and more complicated because they can't, all the really simple ones have been taken. All right? You can no longer do an average true range. You can no longer do an RSI. That's taken. So what I'm going to do, I'm going to make a multivariate indicator, and people think that this is so complicated, it must work. All right? That is not the way to approach that. Very many times these indicators are unnecessarily difficult and unnecessarily built. They're just built to get somebody's name on an indicator, essentially. So be very careful of that. Adding additional indicators is not the way to go. All right, so let's apply our strategy. All right, we talked about the fundamentals, we talked about the technicals. Now we need to see how to incorporate them, how to marry them together, and put them into really our approach to each currency pair. All right. So strategy and combining the fundamentals and technicals, we have 3 points here. Know the market environment, identify the trend, and know the catalyst. All right? Essentially, you know what the market is doing. All right? You're identifying what the common trend is, and then the catalyst is knowing when to get in, knowing to react. All right? Setup and then action. Knowing the current environment, prominent themes, right, from a fundamental perspective, activity level from a technical level perspective, identifying the trend. You see the trend through its existence just by looking at the charts. Obviously, if I were looking at the S&P 500, that weekly chart that we saw earlier, we saw that very big, long uptrend. All right? But the stability is a fundamental consideration. That's when we start to question whether that trend will continue and be stable as it is. And the catalyst. What is the shift, the technical breakout? Those breakouts from that congestion zone, that's the catalyst to a new move. But it's oftentimes we have to incorporate the fundamentals that say this is the indicator that will encourage that breakout. All right? Now, let's go through it. Market environment. First thing we're looking at here is we're seeing that the Aussie dollar versus the interest rate expectation, or the yield spread, sorry, the 10-year yield between the Australian government bond and the 10-year yield for the U.S. government bond, and you can see that they're deviating. All right? So the market environment right now, from a fundamental perspective, is that the theme of interest rates, the actual payouts on interest rates now, are not necessarily that good of a driver for price action. You're seeing that it's deviating from the Aussie dollar. So that theme is shifting, it's waxing. But more important, we can see that looking for that driver, we turn over to the risk appetite trends. S&P 500 versus the Aussie dollar, you can see very strong trend, all right? Very good correlation, all right? And that correlation is driving us over time to a very meaningful and consistent correlation. Okay? And then we look at some of the activity levels and seeing the consistency of this trend. You can see ATR, it's dropped off. Volatility, I use that as volatility, has dropped off a little bit. It's becoming a little bit more stable. And if it's coming stable as the price action itself is starting to go to the upside, starting to accelerate, then that's a good sign that this is a good, potentially consistent trend. All right? You get a good backdrop for market activity. Then we get into identifying the common trend. Obviously, this is a bull trend. All right? Aussie dollar, we're sticking with this example. You can see that we have a nice upward slanting channel, very consistent, and we're getting a very steady run. All right? You can get pullbacks, that's certain. All right? But those are corrections, all right? Corrections to larger trends. And then we're starting to talk about the fundamentals of this. This is where people start to get a little fuzzy, all right? But risk appetite, we just saw that, all right? Risk appetite is starting to flag as global growth slows. So the S&P 500 is dropping off. And we just saw the S&P 500 and the Aussie dollar charts, very highly correlated, all right? Current Aussie interest rates are high, U.S. rates are low. So there is still a high yield differential there. But the rate expectations for Australia have dropped off sharply. They're now looking for about 5.25% rate cuts from the RBA over the coming year. So interest rate expectations have gone negative. All right? Deficit troubles in U.S. accelerating reserve diversification, but is this necessarily more important than other fundamental themes? We have to balance that out. And safe haven lines no longer clearly defined, which is a problem with the U.S. dollar. All right? So bottom line, fundamental stability is starting to waver from a global perspective, and that's going to undermine the high-yielding currency, and it might even undermine the U.S. dollar a little bit, but the U.S. dollar will maintain its safe haven status a little bit better. So I'm going to be really paying attention to the U.S. dollar in this aspect, thinking of medium term, the U.S. dollar is probably going to appreciate, potentially quite significantly. All right? And then we look for the catalyst, the event risk. All right? You can see here that we have, I went back in time just to give you some examples of some significant event risk. You can see that we had U.S. GDP, and we also had the RBA rate decision, non-farm payrolls, all of this very notable event risk. Right? Knowing this event risk comes, and if we have the expectation that the Aussie dollar in the medium term looks like it might want to reverse because the fundamentals theme is shifting, that rising trend is kind of growing a little bit too mature, then the potential for a correction, you're looking for something that will catalyze that move. If you need something that catalyzes that move, these known indicators, they're good potentials. Right? And then we look for the actual progress of that breakout. All right? So the initial breakout was the move to the upside. And from there, if you want to come back to the Daily FX booth, we can talk more about what's happened recently. But from there, we can actually see that it topped out a little bit, and now it's pulled back. Now we're getting a very loose-looking head and shoulders pattern, and you can see some of the technical lines that we need to follow as this really develops. So we look for these technical supports and resistances, and as they break, then we see that these shifts are occurring. It's actually the action. All right? We have the setup, and now we move to the action with the event risk and with the technical breaks. All right? And that's it. Incorporating this can actually be done in all currency pairs. All right? I know it's very difficult, and I know that it's probably a little too fast for you guys to really incorporate everything that I just said. But if you want this, do email me, or you can come up and get my business card, and I can email you the presentation so you can go through it as many times as you want. And this will also be online, I believe, in about a month and a half. Okay? Thank you.